Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to talk only and only about share capital. What is this term, right? Now capital, you all know where we have studied sole proprietorship, we have studied partnership. There is a term capital. What does that mean? It means the amount being invested by the owner of that particular business into that business, right? So when we prepare a balance sheet, right, they have two sides, liabilities and assets. In the liability side, it's mentioned, let's say Mr. X capital, how much capital he bring into this particular business. If it's a partnership firm, we write the name of the partners, how much capital Y brings it, how much capital Z brings it. So this is the capital that they invested into that firm, right? Now when we say the share capital, it means the same. The share capital means the amount being invested by the owner of the business into that particular business. But share capital term is being used when we talk about companies. Okay, when we talk about companies, they use the term share capital. Share capital. Now let's say the total amount being invested by all the owners of that particular company is 6 lakh. Okay, this will be the share capital amount which will be shown on the liability side of the balance sheet. Along with that, what they will mention, this 6 lakh, like if they have approached to the people for the money, the people have invested money into that business, but how much everybody has invested, how they will get to know? What they will issue? They will issue a share certificate. Okay, now how they will issue a share certificate, like how they will mention it, 6 lakh, they hold this share certificate, right? This is a certificate which they will give to the public who has invested their money into the firm, into the company, and now they are considered as the owners of that particular company. But they'll be like, when they give that certificate, that particular certificate, that certificate has a certain value assigned to it on its face, and that is known as the face value, nominal value, par value. Mostly it's either rupee 1 or rupees 5 or rupees 10 or rupees 100. This is the face value of that particular share, one particular share. Okay, so if we say 6 lakh of capital is being invested, that means, let's say, each share certificate hold a face value of rupees 10. That means 60,000. 60,000. 6 lakh divided by 10 is 60,000 shares of rupees 10 each is being given to the public. Of rupees 10 each is being given to the public. That much shares have been given. So like, now we have this demat system, digitalization and everything. Earlier they used to give this in a paper form. Okay, so your grand parents, they used to hold these certificates. They used to have it in a paper form wherein everything used to be mentioned, like your school certificate, right? The name of the school is being mentioned. This is to certify that this particular student has excelled in this particular subject or in this particular extracurricular activity. So this is mentioned in your certificate, the name of the school, the sign of the principal, okay, the date on which they have issued this certificate. So everything used to be mentioned in that particular share certificate, wherein they mentioned that this is the name of the company, this many shares have been given to this particular person on this particular date, wherein they put the common seal also. Like the company has a common seal, we discussed about it in the previous video, right? So they put a common seal and everything is mentioned. So this is the what they hold with themselves. That is why it is known as share capital. How many shares I have? Let's say I have a shares of Reliance, right? So that will be mentioned. Let's say I'm having shares, 5,000 shares of Reliance company, so it will be mentioned in that share certificate. So all these things used to get mentioned in that particular share certificate, and the people holding those share certificate are known as shareholders. They are known as shareholders, right? So these shareholders, they are now the owners of that particular company, right? Now when like how much capital, when we say this, randomly they can't decide the capital amount, right? Like today the company will say, okay, now I want 6 lakhs amount of rupees, because I want to buy a particular machinery, let me go to the public and ask for money. Next day I want 10 lakh, next day I want 5 lakh. Like that it never happens, it still don't happen like that. Okay, so these companies are being governed by certain people, okay, who with from like they are governed by whom? By the Companies Act as well as SEBI. Okay, these are the two major governing body who direct them. There are certain rules and regulations they need to follow. So similarly, when like there is thing called memorandum of association. In this memorandum of association, it is mentioned how much capital that particular company will demand from the public. Now, what is memorandum of association? Let me illustrate you in a very simple way. Okay, you are studying in a school, right? It may be a CBSE, it may be an ICSE, it may be a state board, whatsoever it is. So there is a higher body governing your school, right? Your school is there. Okay, there is a body, that is an education board, which is governing your school. Okay, they have that agreement, affiliation agreement between these two. The school have to function as per the education board, right? The education board will decide like what will be the name, like what will be the syllabus of particular subject, what will be the name of that particular subject, what will be the topics that will be covered in these particular subject, how much it will be covered. Everything is being decided by the education board, and there are certain rules also which this school has to follow, right? Like school can give only a school certificate to the kids. School can't give a university certificate. Okay, they are being governed by the education board. They can give the school certificate to the kids, not the university certificate. So all these agreements are being made between the school and the education board. Similarly, when we talk about the companies, there is a governing body which is Companies Act, okay, and SEBI. They decide, they, this memorandum of association, they have to work as per the Companies Act and as per the SEBI. In this memorandum of association, they will mention what will be the name of the company, what will be the, like before this starts, they have to give, they have to get it approved by the Companies Act and SEBI. So what will be the name of the company, what, where will be the registered office of the company, what is the objective of to of this particular company, and how much capital this particular company will demand from the public. So this is all mentioned. I'm just talking about right now capital. So this is all mentioned in the memorandum of association. They can't go beyond it. And the capital mentioned in this is known as authorized capital. How much they are authorized to ask from the public. Okay. And now like school have their internal rule book also, right? Internal rule book wherein they decide what will be the dress code. Though it's a CBSE board, every CBSE board kids have different school uniform. So it's on school, they have their own rules wherein they will decide what will be the dress code of the kids, what will be the disciplinary actions they will take, or else what will be the functioning of the whole school, operational activities of the staff member. This is the rules that are being decided by the school. So this, we can say, is an article of association in case of a company. Memorandum of association, we can compare it with the education board which is being mentioned. We can't go beyond its rules, but this internal rule book is what the company decide on its own, that is known as articles of association, wherein they will mention, okay, if I want, the company wants like do meetings, when the meetings will be held, what will be the transfer process of share transfers, and how much dividend, what is dividend, I will explain you, like what all these things will be there, will be mentioned in the articles of association. So when we talk about shares, the capital, how much capital the company is authorized to ask from the public is mentioned in the memorandum of association, and they can't go beyond that limit. There is a process if they want to make any certain changes in the memorandum of association. So when we talk about share capital, there is an upper limit which is known as authorized capital. This is the maximum amount of capital that they can demand from the public. Okay, after authorized capital, there comes, let's say the authorized capital in this case is 10 lakh. Okay, 10 lakh. So after this there come issued capital. Now the company will issue a prospectus before demanding money from the public. They will issue a prospectus. Now what is a prospectus? They will say to the public, to the general public, like what function they are going to perform, what is the objective of that particular company, why they want money. They will issue to the general public so that the people will get to know about that particular company, because they are, this is the IPO, initial public offering. Okay, there are two things. IPO, when the company wants money from the public for the very first time, it is known as initial public offering. So in this, when they go for IPO, they need to mention everything about that company to the people, so the people will get to know, okay, how, like whether they rely on it, they don't rely on it, whether they want to invest, don't want to invest. Based on that they will decide. So they need to issue a prospectus. When they issue a prospectus, people will get to know about it, and then they will invest money into that particular company. So how much money they want? Okay, how much money? Let's say they want 6 lakh rupees. Okay, 6 lakh rupees, 60,000 shares of rupees 10 each. Okay, they will mention everything, how much money they want, how much shares they will issue, and what will be the nominal value or par value, or what will be the face value. This is the terms which will be used when we talk about each share value. What will be the face value of that particular shares? Okay, so that will be the time, like for the first time when they are asking money from the public, that is known as initial public offering, and they will mention how much capital they will ask from it, and the money that they didn't ask is known as unissued capital. That is, in this case, if 10 lakh is there, then unissued capital is 4 lakh, which they can demand from public when they make the next public offering, that is a secondary public offering. Okay, that time also they will issue the prospectus, but that won't be in such a detailed way. It will be in a brief way, because they have already mentioned to the public. So unissued capital still not demanded from public. Till the time of winding up, they can anytime ask this money from the public. So this is will be the 4 lakh amount is called as unissued capital. Now when they issue a prospectus, they will mention 6 lakh. Then people get to know, people will subscribe for it. Subscribed capital, they will subscribe for those particular shares, right? Like, okay, people want the shares of this particular company. When they subscribed for it, there is, let's say, 60,000 shares of rupees 10 each, and they can ask this 10 rupees at one go. Okay, or in installment. They can demand at like one go. Okay, not just now we need the money, so they can demand it at very much that time only, 10 rupees, or in installment. Okay, one installment, second installment, third installment, like that they can go. So subscribed, how much they have subscribed to that particular, how much people have initiated to buy that shares of that particular company, is known as the subscribed capital. Now in this case, let's say subscribed capital could be 6 lakh. Okay, this is like this much they ask for these many shares, and people subscribe for it, and this is 6 lakhs is the subscribed capital. But there could be over subscription, and there could be under subscription. Okay, over subscription and under subscription. What do we mean by over subscription? Means over and above people have asked for the shares of that particular company. They asked for 60,000 shares of rupees 10 each. There are 65,000 people who want 65,000 shares. So this 5,000 is known as oversubscribed. Okay, oversubscription. Now if it is oversubscribed, that doesn't mean the company will keep that particular amount with it. They need to give that particular amount to the people. Like if it is oversubscribed, 5,000 shares have been oversubscribed, they have to return the money, 5,000 into 10, that is 50,000 to the public. Okay, they can't go beyond the issued capital. Okay, there is a limit. Beyond the issued capital, subscribed capital will not go. So subscribed capital will either be equal to the issued capital, or subscribed capital can be under subscription, can be less than the issued capital. Under subscription means less people have demanded the shares of that particular company. Let's say it is 60,000, but people people have invested 58,000. Okay, 58,000 means 5,80,000. Okay, so it could be less than the issued capital, but for that also there is a limit. There is a limit of minimum subscription. Minimum subscription means what? That 90% shares should get subscribed. If it is less than 90%, that means the company has to give back the money to the general public. Like 90% of 60,000 share is 54,000. So the minimum subscription should be 54,000 share. It should not go like less than that. It should not be 50,000. If 50,000 shares have been subscribed, or 30,000, 20,000, whatsoever could be, if it is less than the minimum subscription, 90%, remember, minimum subscription should be 90%. If it is less than that, that means the company has to give back the money to the people. Okay, within that limit of 10 days when they issue this offer. Okay, if at all the company is not able to give back the money, then they have to pay interest at the rate of 15% per annum till the time it makes the payment. So this is what they have to follow. Issued capital, the people will subscribe, people have subscribed, but if it has gone oversubscribed, then the shares which has been oversubscribed, they have to give that money. If it is undersubscribed but it is above the minimum subscription, then it is fine. If it is below the minimum subscription 90%, then they have to entirely give back the money to the public. Okay, if they are not able to give, then they 15% interest will be charged at the rate of 15% per annum. Okay, so this is the subscribed capital. Now it's not mandatory they will ask for the whole amount. Okay, they will not ask 10 rupees. As I mentioned earlier, that they may ask 10 rupees the whole amount, or they may ask in installment. Okay, so then comes the term, after subscribed capital there comes the term called up capital and uncalled capital. When I say called up capital, that means how much, like if they want let's say 8 rupees has been called off. Out of 10 rupees, 8 rupees they have asked till that much time. Okay, 60,000 into 8, 4,80,000 will be the called up capital, called up amount from the public, that till now they have asked for just 8 rupees per share. Remaining rupees 2 per share they will demand in a future time. Okay, future date they will ask for rupees 2. So till that time how much they have called up from the public is known as a called up capital. Called up capital is, again, there is paid up capital. Paid up capital. Now what is paid up capital? Paid up capital means how many people have paid for that particular shares. They have called in installments. Let's say earlier 5 rupees, then 3 rupees, then 1 rupee. So like that, let's say 5 rupees, 2 rupees and 1 rupee. Let's say they have called in that particular manner, but there is one particular shareholder who has not paid. Okay, that is known as calls in arrears. Calls in arrears, like let's say there is person who is holding 1000 shares and he has not paid a particular installment, and will explain what is it called, but he has not paid a particular installment. So 1000 into 1, that is 1000 rupees are calls in arrears. Okay, so this is how it is. There's an authorized capital, issued capital, they will issue a prospectus. Unissued capital, they will ask for it in the second public offering, then issue a prospectus, they will mention everything, people will subscribe for it, not mandatory that they will ask for rupees 10 each, the full face value amount. Okay, it could be in installment, initially 5, then 2, then 1. So it could be in installment. When they ask money from the public, the shares could get oversubscribed or undersubscribed. If it is oversubscribed, we need to pay the money to the public. Okay, whatsoever it could be, the subscribed capital can't go beyond the issued capital. Or it could be undersubscribed. If it is undersubscribed, they have to follow, like how much is the minimum subscription. 90% should be the minimum subscription. If it is below 90%, they have to entirely pay the amount. If it is undersubscribed 60,000 but it is above the minimum subscription, then they can issue the shares. But if it is below 90%, they have to entirely pay off the amount. If they are not able to pay, then interest at the rate of 15% per annum will be charged. So this is how the company has to function. Now, earlier they used to issue a share certificate, as I mentioned, like they used to give share certificate. People used to personally hold those certificates. Okay, but like this, that has now changed. Okay, that has now got digitalized. There is a demat account wherein people online transfer the shares, because earlier it used to take 30 to 90 days if anybody wants to sell those shares, if somebody wants to buy those shares, all these process. Now everything gets, all these transaction happens in T+1 day, that is transaction day as well as in the next day, and the transaction gets done. This you are going to read it in your finance how it happens, but now it has become a lot more digitalized, right? Like there's a people open their demat account. If they want to buy a shares, their account will get debited, they will pay check or the pay order, or else there is a term known as ASBA account, application supported by blocked amount. Like now what the happens, that the amount will get blocked from your account. If you get the shares of that particular company, then the amount will get debited. If you have if you didn't get the shares, then again that amount will get transferred into your account. So all these things are happening now, and I hope you got all these things. Let's talk about dividend. What is dividend? Because then I will talk about the two types of shares. Okay, so dividend, like as we said, that this is the balance sheet. The company used to earn profit. If the company earns profit, that profit will belong to who? To the owner of that particular business. Okay, if it's a sole proprietorship, the whole profit belongs to that particular owner. If it is a partnership, the profit will be divided among the 3 partners. So what about company? What company give to the owners? They give dividend. Okay, they give dividend because now, like that, they give a part of the profit as a dividend to their shareholders. Okay, because the profit belongs to the shareholders. Now when they give dividend, if it's not mandate that they give dividend, they may give, they may not give. That is all being mentioned in their articles of association. As I said, that is their internal rule book. How much to give, when to give, all these things are being decided by the internal management of that particular company. Now let's talk about 2 types of shares. Okay, now we know what is shares. Shares means you have a share in that particular company, you have invested that amount in the company. But this authorized capital is mentioned in the memorandum of association. Okay, now this authorized capital, how much will be the capital they will demand from the public, that is mentioned. But like in what ways they will demand, like there are 2 types of shares. One is equity shares and another one is preference shares. These are the two types of shares. Now, preference shares. When I say preference shares means what? They get preferential right before equity shareholders. Preference shareholders will get the preferential right. When they related to what they will get the preferential right? Related to dividend. That is why I first explained the concept of dividend. So when the company is giving dividend to their shareholders, first they will give whatsoever, it is being mentioned, like in the preference shares it is mentioned 8%, 10%, 5%. That means 5% of the dividend, 5% of the like the shares that they are owing, for that they will get 5% dividend. So they will get preferential right over dividend. After giving dividend to the preferential shareholders, then there's dividend whatsoever. It could be so much, it could be so less. So whatsoever it is, it will be divided among the equity shareholders. Okay. Similarly, they have the preferential right when there is a winding up of company. When there is a winding up of company, then the preferential shareholders will get their capital amount first before the equity shareholders. Okay, so when the company winds up, they pay off all these liabilities first, the third party liabilities. Every time, just need to remember, in any situation, first to pay off the third party liabilities. After that, they will give the capital amount to the preferential shareholders, and after that equity shareholders will get the amount. Even preferential shareholders, there are certain types like cumulative, non-cumulative, redeemable, irredeemable. Okay, so all these things, participating, non-participating, related to the voting rights, all these things are being there in preference shareholders, which you will learn later. So equity shareholders, they are the real owners of that particular company. Real owners means the one who take the risk, and the one who take the risk a lot, they'll get the benefit a lot. Okay, so in that case we can say that if dividend, that is fixed, right? The dividend is fixed in this case, but in equity shareholder, dividend is not fixed, so they can get a lot. Okay, so this is how I can say it's all about this capital, right? In the next video, we will discuss about the accounting entries when they call all these amount, right? Okay, so in the next video I want to tell you what is, how they will what will be the application money, allotment money, what will be the journal entries for that. So next video we will take the journal entries when they ask money, and we will just take one more illustration also related to that. I hope you got it. See you next Wednesday. Till then, thank you very much.